Hello, class. As we start part two of our uh, podcast explanations of chapter two, just checking what we've already learned, some concepts. Go back and look at if you're in the process of getting a divorce, can you file married filing jointly? As long as you are not actually divorced, you are still married, and so you can file married filing jointly. And in fact, you can't uh, file a single because you are still married. Once you have a divorce in place, even if it's on the last day of the year, that is what governs. Um, and just so you know, Social Security number of the taxpayer's spouse is shown the taxpayer's tax return when filing a married separate return. Yes, they're going to look very carefully because if you file married filing separately, that you haven't double counted deductions or things on both returns. So they're going to want to match those up and make sure that you handle things the same way on both returns. You get very little tax benefit. Surviving spouse who qualified as married filing joint when the spouse died can file as a qualifying widow for the next 2 years as long as they pay for more than half the cost of keeping up a household and does not remarry. Well, it's not quite that. You have to be more than that. It has to next 2 years, as long as surviving spouse pays for more than half of the cost of keeping up a household for a dependent child, okay, and does not remarry. So that part is left out, and so that, as stated, is not sufficient to be a qualifying widow or widower. All right, so let's just remind everybody that tax returns are filed as as individuals and as couples. Okay, there's no filing status that considers how many children you have other than being able to claim head of household. So, what are how are the rest of the people in your household treated? Now, first of all, if they are dependents, okay, on the main breadwinners, they file their own tax return. So, tax return can only have one or two filers. Anybody else with income, no matter how dependent they are, is not does not file their income on that same tax return. So I have children, they're teenagers, they're making their own money, they file their own tax return separate with their income, separate from mine. If my parents live in my home and I provide for them because they're getting older, um, even though they're dependents, any income they receive from investments or for Social Security would be filed on their tax return separate. It would not be my income, it would be their income. Okay, so the idea of what a dependent is important, but it does not mean that their income is included on the tax return. But it is, and there's not an automatic deduction. There are credits and determining filing status and other matters that you have to know the dependent definition of a dependent. So they must be qualifying child or a qualifying relative, and we'll get to those, and meet these three tests. Okay, can't be claimed by someone else. Every dependent can only be a dependent of one other person. Okay, there is no splitting, there's no halvesies. Okay, you're either dependent or not, and if you qualify because of the rules, and sometimes the case will be qualify for if to be a dependent of two different people, then there has to be a tiebreaker. There cannot be a splitting. Okay. Um, if you're a dependent, you cannot file a joint return with your spouse unless your income is so low as that the only reason you had to file is there's no, is to claim a refund because there's no liability on the return. Okay, so there is a level of income under which you do not have to file a return. Typically, it's the standard deduction. And if you don't have to do that, if you may file just to get your refund back. And you have to be a resident, as it says there, okay? Citizen or resident to be a dependent. Now, just so you understand, if you prepare other people's taxes, these are questions you have to know about anybody that they claim as a dependent. They have to, and you have to sign off that you have looked at the documents and that you feel comfortable that they are a citizen or resident and they're just not making things up in terms of dependence. So remember, it has to be a qualifying child or a qualifying relative, and those three things assume the other three tests are satisfied. How do we be a qualifying child? 5 specific tests. Relationship. Okay, so most of the time this is lineal relatives. So your children and grandchildren, okay, are meet the relationship. Age, under 19 or under 24 if they are a full-time student. Okay, residency test in the United States. Support test. No one else can be supporting this child for it to be a qualifying child. And of course, there's a might say a tiebreaker, special test for qualifying child, more than one taxpayer, meaning both have custody, maybe they even split custody 50-50. How do you figure out who gets, who's providing the support, all that type of thing. Notice the support is not that you provide the support, it's a negative test in that no one else is providing support, including the child. Is providing more than half of the support. So you don't have to prove that you provide more than half. You just have to prove that nobody else is providing more than half. Okay, we talked about this. Age 19 or under 24. Okay, and they have to be younger than the person claiming the dependency as of 2008. Now, what if he doesn't fit? Okay, qualifying relative. Well, if they're a qualifying child, they're a qualifying child. So basically, we're talking about people that don't fit the relationship. So this is much broader. This includes parents and grandparents and uncles and aunts and nephews and nieces, but not cousins. Okay, they can either be related, or we are so generous as to include them as a dependent, even if they're no relationship, as long as they are a member of the household for the whole year. So if you just find somebody, okay, and adoptive child is a qualifying child, okay. Foster children could be qualifying children, but this is just someone that moved in. You saw you're out on the street, you said, okay, you can come live with us, and they move in. If they're there the whole year, they don't have to be related to be a qualified relative and therefore be a dependent. Now, big difference between a qualifying relative and a qualifying child. There is no income test for qualifying child. There is for qualifying relative. They cannot have gross income equal to or greater than $5,200. That's not a lot of money, but that is the limit on their income. Okay. Now it has to be, that can be taxable income. So sometimes Social Security won't count because it's not taxable. All right. So that can allow for parents to be dependents. And you have to provide more than half of the support. And if you don't, then there has to be, if there are multiple people that pay in for a parent, for instance, we have a homework problem that talks about this. They pay in there's a whole series of things to look at. If no one puts in 50%, then you have to look at only the people that are related, and then they have to put in over 50%. And there can be situations where no one can take the dependent. Someone is not a dependent of anyone. But you can't never have it more than one, right? You have to have a test to figure out the one person that gets to claim someone as a dependent. All right, so standard deduction amounts just for inflation every year. So these are higher than they were in 2024, and they'll be higher again in 2026 for this tax year. We're in 2026 preparing tax returns for 2025. So these are the ones we will use. Notice that single and married filing separately are the same. Married filing jointly and qualifying widower is the same because it's really the same thing. You can continue to use the married filing jointly after your spouse passes away as long as you have a dependent child. Now, this is where we can get a little extra. Okay, there's increase for people who are over 65. Okay, at the end of the year, if you turn 65 at the end of the year, okay, you qualify for this extra standard deduction. This is on top of the numbers given in the last slide. Or if you're blind, other disabilities we didn't write into the law, but this, if you're blind, you get a extra standard deduction. You get one for being over 65, one for being blind. So a couple filing jointly could have, if they're both over 65 and both blind, they would have 4 increases to their standard deduction. Okay. Also, if you can be claimed as a dependent by another taxpayer, okay, remember you're filing your own tax return. This is my son, or daughter, living in a house, working a summer job. Standard deduction is limited to the higher of $1,350, okay, or the taxpayer's earned income plus $450. So if all their income is a summer job for $2,000 or $3,000, that's well below the standard deduction of $15,750. Okay, so that their standard deduction would be the earned income they got from the job plus $450, which wouldn't matter because the standard deduction would reduce their income to zero anyway. The extra $450 would just make it negative, and that doesn't help anybody. So the $1,350 really only comes into play if somebody who's a dependent has a whole bunch of interest income, let's say, because that's not earned income. So they have a standard deduction of $1,350. So if someone has grandpa dies and leaves a whole bunch of money to his grandkids, they don't work or anything. They're dependents of their parents, but they are earning all this interest, okay, and they can't even touch, let's say they can't even touch it, but they still earn it, because that's how grandpa left it to them. They could receive $1,350 of interest, and that would still be wiped out by the standard deduction. It's $1,350. But if they made $1,450, then they'd have $1,450 of unearned income minus the $1,350 standard deduction, and they'd have $100 of income that they'd have to report on their tax return. Okay, so that's how that works for someone who is this dependent of someone else. The additional standard deductions are given here. Notice it's a different amount for the 2 things that are single and the 3 things that are married. Okay, so there's the married filing separately is along with married. Yes. Okay, so you've got single and head of household 2,000, and married filing jointly and separately, and qualifying widower 1,600. Okay, you don't get the extra when spouse has passed away. based on the 2,000, you get the 1,600. And remember, this is added to your regular standard deduction. Besides this, we have a new personal exemption, a new term that harkens back to some tax terms we used to use in the tax law years ago. Deduction is $6,000 for married filing jointly or a qualified individual, and it's all about your turn 65, and okay, and you're getting this is to help offset some of your Social Security earnings and make it so there more of it is not taxable. Okay, up to $6,000. Okay, that's part of the new Schedule 1A. All right, so that would only qualify for those that are over 65. So practice in calculating the standard deduction, which you will need for your homework. Okay, so 1570, 750, they're blind, single, add the 2,000. Okay, head of household, no extras, so just 21,900. And married filing jointly, 31,500 plus the 1,600, because one of them is 67. Neither of them is blind, so they get one extra. So then you calculate your amount of tax liability. We've already talked about tax tables or tax rate schedules in Chapter 1. Those tax payments and credits reduce the tax liability. We talked about that prior. Okay, and your payments in. All right. Tax credits can be either non-refundable or refundable. We did not mention that in Chapter 1, but that is true. Non-refundable ones can only reduce your tax liability down to zero. Refundable ones can actually result in you having a negative liability or being owed a refund. And that's important to realize. Obviously, refundable ones are more valuable than non-refundable, because if you don't have a tax liability, the non-refundable credits don't do you any good. Okay, and this is just the end result of our more complicated, you might say, tax formula. Now, what if we mess up, okay, in paying our taxes, or don't pay them, don't pay enough, any of those things? We're going to be charged interest. If they audit us and they find that we did something wrong and made an error, okay? So this is the type of rates you'll be charged interest-wise, which really is basically the going rate out there in the world, a short-term rate plus 3 percentage points. So you can see as interest rates go up and down, it goes up and down, and that's what it would be used to calculate on your unpaid taxes or your assessment. Now, besides the interest, you have what's called penalties for not doing what you need to do. And the worst one is the failure to file a tax return, 5% per month or fraction of a month. So even one day into the second month and you get a 10%, okay, right? So if you go 1 month plus a day, that's 10%. 1 day less than 1 month is only 5%. Okay, so as soon as you go over 1 month, you are into the second month, and you got 2 times 5%, and as soon as you go into the third month, you get 3. Okay, but the good news is it's not going to exceed 25%, even if it goes past that. This is if you didn't file a tax return. You can avoid this by filing an extension if you are just behind and not getting to it. But if you don't file an extension, this is going to be attached to you if you don't meet the deadline. Okay, so this is nothing to mess with, because that is a lot of money if you owe money. Now, notice, okay, 5%, it's based on the amount you do. All right, so if you don't owe any money, not going to hurt too bad. If they owe you money, if you're supposed to get a refund, they figure you have every incentive to turn your tax return early, or as soon as possible. So they don't need to really worry about it. But as you can see, it's based on what you owe. Any income tax return not filed within 60 days. So if you go past that 60 days, the minimum penalty, no matter what this 5% or whatever, is $485, or the whole amount tax required on the return. Okay, so that could literally double your amount you owed. Now, your failure to pay tax penalty, and I always tell people, if you can't pay, you still file your return, because that 5% per month is very expensive. Failure to pay tax penalty, if you don't pay your tax, you send it in, but you don't pay it, okay, or don't pay it enough, it's going to be 0.5% per month. That's 10% of the other one, not to exceed 25%. Of course, that can go on for a lot longer until you get up to 25%, but that is so much less. And if both of them apply, you only do the 5%, okay? So the maximum is when both of them it's only 5%. So you don't tack onto each other. The 5% is the maximum. All right. Now, if you don't pay estimated income tax, meaning you didn't prepay your taxes during the year, you didn't have enough withheld, or you didn't make extra payments, you either have to pay in what you put in last year, or 90% of what you owe this year. Unless your income is over 150,000, then it's a little harsher. Okay, that is, you're going to pay, and essentially it's interest on the fact that you did not pay in. So IRS wanted your money as you earned it during the year, not to have to wait till April when you file your tax return. Now, accuracy related penalty, this is going to happen when you get audited, or even when, typically, if you admit the error and file an amended return, you can avoid some of this accuracy related penalty, because you're kind of coming forth and you're saying, my bad, I realized this was wrong. And if it's substantial, they could ask for the penalty, and then you maybe could ask for it not, saying that I haven't done this in the past. This is a honest to goodness mistake. Okay. But when there is substantial understatement and they find it, you didn't come forward, then they can assess 20% of that on top of what you owe, right, as a negligence or understatement penalty. Then it can get really bad if they think that you intended to avoid taxes and they want to put you into the fraud area. Typically, this is going to be referred to the criminal division of the IRS, and you don't ever want to talk to those folks. That's when things get really expensive, 75% of the amount you owe. This could also result in fraud, is where you start talking about possible jail time. So that's pretty serious. Okay, sending in a claim for refund just to see if they'll give you money, knowing that once they check everything, they'll disallow it and they'll have to ask for it back. You're just hoping that in the meantime that they'll forget about it or something like that. They realize that is 20% on top of this allowed amount, the amount that they're going to ask for. Okay, if they've already done the accuracy related penalties, either this or the other one. Okay, so this claim for refund, this, because the other one's based on what you owe, this is going to be on what you said you should get back, which you weren't entitled to. All right, so taxpayer filed an automatic extension before April 15th. But June, he paid the amount due, so he's late on paying. Okay, so that applies the failure to pay 0.5% times 2 months, because it's before the third month starts. But he doesn't have the failure to file return because of the extension which would have upped that to another would have upped that to 300.